Partnered by Times Influence.
India's financial markets are poised for greatness, but market volatility does add a blip to their stellar performance. The times are tough, but we'll ensure that you sail smoothly through. Hello and welcome to Aditya Birla Sun Life Mutual Fund presents Voyage Navigate 2018 powered by ET Now. After a successful run of 4 years, Voyage Navigate 2018 is back in its 5th year and it continues to decode both local and global market trends and also guide us on the way ahead in 2018. Let's take a look. Voyage Navigate 2018, the flagship event from Aditya Birla Sun Life Mutual Fund, has gone a notch higher in its 5th year. The event is aimed at empowering distribution partners, institutional investors and individuals to make informed decisions across changing time and tides of volatile Indian financial markets. Voyage Navigate 2018 recorded an overwhelming response with over 2,000 participants from across countries.
Very warm welcome to each one of you for our 5th year investment voyage event. It gives me immense pleasure to receive our esteemed guests and valuable partners to this signature event of Aditya Birla Sun Life Mutual Fund. In fact, this event now is being a keenly awaited event in the mutual fund industry year after year. As you all know, the mutual fund industry is at an inflection point, growing at a tremendous speed year after year and achieving new milestones in the form of huge asset base coming from the wider participation of investors across the country. In fact, asset management industry has now become the fastest growing industry among the financial service industry, growing at 4 times more than the GDP growth rate. I am sure we will soon start measuring our size of the mutual fund industry as a percentage of the GDP size. As it is, another interesting trend that has begun to emerge, which is nothing but measuring the mutual fund industry size as a percentage of the banking deposit size. As of now, it stands at 18%, which used to be somewhere around 12 to 15% in the previous years. It also indicates the opportunity for all of us to tap as we move forward in terms of getting more and more investors into the mutual fund industry. And time will come where mutual fund fixed income schemes would directly compete with the bank fixed deposits with, of course, no guarantee, no promise of return, but on convenience and long-term tax-adjusted return experience basis only. When I look back, mutual fund industry growth has surprised everyone, and so has our asset growth. Many would have forgotten about Brexit, but one factor remains the same, is the uncertainty and challenges which comes and face every year, and that becomes a part of discussions. And we have seen at the same time a flourishing market, which of course came as unexpected, and fortunately some of our predictions have also come true in the last few years. As we move to the new financial year 2018-19, the road ahead seems to be filled with lots of unknown variables that could affect the market sentiment. And these unknown variables may keep both equity market and interest rate market volatile. Having said that, we are already seeing a pickup in micro variables, which is nothing but a reflection of economic pickup. The macroeconomic variables, though, is on the edge, but I personally feel that we are building an economy which is getting future ready. With the 2 bold reforms, such as the demonetization and GST, which are powerful and mother of all reforms, should help in differentiating India from the rest of the global economy. We remain humble and stay committed to build our business with wonderful partners like you. Let me conclude finally with a quote from Warren Buffett, which goes in line with the future ready, which is nothing but someone is sitting in the shade today because someone is planted a tree a long time ago. So I am sure all of us, the seed that you are planting today, definitely the benefit will come to all of us as well as for investors as we move forward. Thank you and enjoy the day.
From industry experts, it's now time to move towards policymakers. Our next speaker is Dr. Ashima Goyal, who's a member of the Economic Advisory Council to the Prime Minister of India and also a professor at the Indira Gandhi Institute of Development Research. And she takes us through India's roadmap towards growth. Let's take a look.
These are choppy waters, but exciting, and you can build really strong businesses in these circumstances. In India, we are lucky to have high growth, which is among the highest in the world, but it is low compared to our own potential and requirement. The puzzling thing about Indian growth is that since the end of the last century, we had reached a PPP level, after which countries that are undergoing a growth transition or catch-up growth normally have a steady rate of growth. The reason for this is that you build all kinds of dense networks, all kinds of activities that feed off each other, strong institutions like Birla AMC or the Aditya Birla Group, a large number of such institutions. But Indian growth has been volatile. Why is this? If you see the advice which comes from abroad for countries undergoing this kind of reform and transition, it is normally stabilized because in developing countries you tend to have demand which exceeds supply capabilities. So stabilize, reduce demand, liberalize because you come from a background of too much government intervention, privatize, open out to the rest of the world. And the strange thing is that after so many years of reform, this is the advice we still get. The recent World Bank country report flags just these 3 items. But the same World Bank, there was a report some years back that decided that instead of looking at countries that are stabilizing or liberalizing or reforming, we look at countries that succeeded in undertaking sustained growth. So this was the Spence report. And it found that the countries that grew at above 8% for more than 15 years and transformed to middle-income countries followed very pragmatic policies. It was not just market reforms. It was understanding context, what is needed, developing special micro-incentives that would work in the context of that country. There are some signs of a more diversified financial system, a more modern, diversified financial system developing. And one of the aspects is really more household savings coming to mutual funds. When, like this AMC, when we get Chinese visitors in our institute, they would normally, ask about ICT, but now they've been asking about markets, because one of the things of an FPI-led or foreign portfolio inflows-led approach is really that you're developing modern financial markets. But in India, we've not been able to develop a corporate bond market to finance infrastructure, which is one reason public sector banks were pushed into this kind of lending with asset liability mismatches after we had shut down development financing institutions. But the problem, what the Chinese visitors would say is that FPI is volatile. You're setting yourself up for volatility if you're focusing on foreign portfolio inflows rather than direct investment. But I think, therefore, when we have household savings at last coming into mutual funds, perhaps in a steady way, we hope that it will survive the current volatility, then that makes for less volatility overall. We have seen portfolio inflows that have gone out, but they have always come back after periods of global risk off. And households were investing much more in equity in the early 90s, but they actually exited these markets, and it's only recently they've come back. Household financial savings have really grown in equity through the MF route. And it's up to you and what you do and how you convince households to survive the current rough patch, give them good returns. So here, stability and good returns and value and taking a long-run approach should really help. The other reason for high volatility in Indian growth has really been that since 2011, we have followed a sort of stabilization strategy. We were pragmatic and did not follow the R's of market reform, but we have been following a traditional stabilization since 2011, so that focus has been on structural reform, which is good from the long-run point of view, but it has implied that there was no smoothing of shocks, either domestic or international, and there were plenty of such shocks in this period. Even so, the list of structural reforms is impressive. It's not just demonetization or GST. If you look at the list, we have improvements in center-state coordination, which is a big thing given our federal structure. And the GST Council has shown that there is great improvements happening in this respect. The very fast response rate, they have shown undertaking major reform. Then, of course, there is the bankruptcy code, the bank recap, RERA, changes in the monetary fiscal framework, the FRBM Act, moving to flexible inflation targeting, technology, Aadhaar, the database, and the ability to build stacks and financial innovations on this, the growth of NBFCs, the focus currently on health insurance, which can improve life for a lot of the average citizen.
It's time for a short break, but on the other side, we get insights from influencers about the changing patterns that are positively impacting India's economy. Stay tuned, we'll be right back. Welcome back to Voyage Navigate 2018. We hear more from Dr. Ashima Goyal as she shares some insights on how to build a sustainable business model in mutual funds and the road ahead for the Indian financial markets in 2018.
I think one need not worry too much about inflation. We tend to feel that the past, we've had an episode of really high food prices. So perhaps our authorities worry that it can recur. But I think there are substantial changes in rural areas. We're moving towards an economy of plenty rather than of scarcity, which is associated with high prices. The other sort of strategic reform direction could be to intensify and use trends at the margin, rather than try to make top-down changes that are very difficult, that will not work on the ground. So, for example, even demonetization actually was related to context in that sense, because the G20, even the international context, their base erosion and profit shifting, identifying income that escapes taxes. And although this created a lot of costs for the average person, but on the whole, there was so much support here, because I believe that as a society, we are ready to move to a new norm where everybody pays a low, fair rate of tax. Technology also helps in moving the informal sector to the formal. Today, firms complain about having to fill GSTs. Small firms especially are finding it difficult. But the data available will help them to get credit faster. And as their accounts improve and are available, a lot of NBFCs are lending based on cash flows rather than collateral. So all this moving towards formalization, if the regulations covering the formal sector become simpler, will actually help improve productivity, make different kinds of facilities available to firms. New technologies are also very suited to India because we are a young country. Our average age ratio is about, in 2020, is one of the lowest in the world, about 29. So we have a lot of young people who can really pick up these techniques. And at the same time, this innovation is reducing prices of mass goods in what we call a virtuous cycle. Actually, we say inflation is high, but we're not measuring the many ways in which technology is cheapening so many of the things we use. So inflation could actually be lower than the measured. A lot of countries in the world is finding different ways of measuring the improvement in productivity and the reduction in daily items of use, the cost of that because of new technologies. Then another major reform in the financial sector is the bankruptcy code. And here, again, it is strategic in the sense that the major problem was taking decisions in the Indian context. Because given that you could, as a banker, you could be investigated by various agencies, it was better just not to take decisions. So we had a lot of delays in dealing with these NPAs. But now the resolution regime with deadlines is going to be very helpful in resolving all this, together with recapitalization, which becomes possible once you know that that money is not going to people who had taken those loans in the first place. So, but again, it's necessary to avoid over-strictness. Just as in macroeconomic policy, we went from too much stimulus to too little. In regulation, you can go from just delay and drift to too much strictness. The third sort of strategic direction is really for reforms for India is jumping to what I call jumping to the future. I think we keep saying that we are zero job sort of growth, no job growth. But in employment, we are always telling old stories. We need to recognize that we keep saying that there is a lot of change and that the path that China took, for example, moving to labor-intensive manufacturing, we keep saying India has not done that, so we've not been able to create employment. But the world has changed, technology has changed, manufacturing has changed. Manufacturing itself has a large element of services in it now. And in Indian growth, services have always been the driver, historically. In the 70s, it was bank nationalization. In the 90s, it was new technologies. In the 2000s, it was construction. And here we have what I call quality ladders. If you have first-generation literates, they cannot jump immediately to become maybe software engineers. So on the whole, I've tried to suggest that we have very, very good things going for us in the long term. And we have gone through a series of structural reforms that have improved matters. And so our growth rates should perhaps in the future be less volatile and more sustained. Inflation should come down because of technology, because of improvements in agricultural productivity, come down on a sustained basis, and anchoring inflation expectations in the new inflation targeting regime, where you know that the policymakers are going to respond quickly to inflation. You will not settle into a persistent high inflation regime, and inflation expectations should come down.
Dr. Ashima Goel sat down for a tete-a-tete with the consulting editor at ET Now, Maithili Busnurmat, to talk about monsoon predictions and threats that can impact the market in the near future.
The mutual fund industry has had a terrific run in the past 5 years. I'm going to turn to Ashima and ask her, what does she think is the future for the economy, as the Modi government completes its 5 years? Because for the mutual fund industry, even though the economy might seem at one level a little remote, the fact is that the two are very closely intertwined.
My own view of potential is rather than past trends, it's sort of forward-looking. If we grow at 9%, we have as long as we are able to maintain supply-side reforms so that inflation does not rise. And I'm saying that we have undertaken certain structural changes, such as rises in agricultural productivity, etc. And I think policymakers tend to be afraid of what has happened in the past. You had a high inflation episode. So as soon as a little rise in food prices, you think that it might lead to second-round effects. But I think this happens only if food prices cross the threshold and are sustained, and we will probably not see that in the future.
So can we say 8% is about India's potential?
8 to 9%.
8 to 9%, but we're nowhere near there. And what we've seen generally is that there's a sharp difference in how India performs and how Bharat performs. So given that you have a mutual fund industry which is slowly spreading throughout the country, what is the future really of Bharat vis-a-vis India? Will the good monsoon prediction that we've got just yesterday, will that change? Because, even though we've talked about the rural economy doing well, the fact is that farm incomes really have not increased dramatically. And the MSP increase, as you said, the farmer's problem is that both in good times and in bad times, farmer suffers. So what can a mutual fund industry, I'm trying to kind of pitch this economy vis-a-vis the mutual fund industry. So what can the mutual fund industry hope to get from the latest monsoon prediction that we've got and the future that you hold out for the Indian economy? Where should they look? Should they look at India? Should they look at Bharat?
Well, I think that more and more Bharat is getting integrated into India. We no longer need to think in those dualistic terms, but that is what development is about, actually. And I think we are under-measuring the changes that are happening in Bharat. We are going on telling old stories, not only about labor-intensive employment and manufacturing, but also that farm income and that poor farmer. It's not farm income, it's rural incomes. And rural incomes are diversified now. It's not just from farms. It's also rural businesses in processing food, cold storages, and in diversifying into all kinds of high-valued crops where you have a lot of supply chains that are supporting you so that you don't run into those cobweb cycles.
You also spoke of the savings rate, household savings moving out of physical into financial. The fact is that the Indian household is also a very smart household. They moved out of physical into financial because of the kind of upheavals that we saw. What is a guarantee that they will stick with financial savings if there is a turmoil in the industry and we see that the financial sector does not give them the kind of returns that they were aspiring for?
I think it has to do with, again, diversification and building a more robust sort of sector where you don't have that volatility. And households don't expect 18% returns and then 5%, but more steady and sustained. So you have a diversified portfolio. So you go into mutual funds as well as bank, as well as some real estate, but not all real estate. And I think that households have really been on a learning trajectory because in the early 90s, they just left equity. They migrated to...
There was a reason why they left equity.
Just fell.
So that really is the worry, even now, if I could interrupt. The fact is households got their fingers burnt once and they returned after a great interval of time. Now, once again, they've been on a good winning trajectory. Will they again burn their fingers? And if that happens, will the return be much slower? Because at the end of the day, an average typical Indian household, I'm not talking about the HNIs. The HNIs can afford to take risks, but the average Indian household cannot afford to take risks. So what he wants is really stable returns. So will it be a case where, again, bank deposits, which they turned away from, will again become the area where they go to?
But bank deposits are not going to give you the kind of returns that they used to give in the past.
You don't see the external sector posing a major threat to our growth. External sector, both in trades of trade protection, the Fed raising interest rates much more sharply, because the US inflation, which nobody has realized, the US consumer price inflation has crossed 2%, which is their target. And there are strong indications that the Fed will raise interest rates faster and maybe more number of times. So both on trade protection, geopolitical tensions, and the Fed, you don't see that increasing interest rates and uncertainty in the country?
I think that I disagree with the word sharply, because the thing about modern monetary policy is that you do everything slowly and you communicate to the markets and they price it in. So it's going upwards. So we must not make the mistake of saying that upward movement is a sharp movement. Earlier you had sharp movements which created havoc with markets. Now you no longer will have that. You'll have better communication.
Thank you so much, Ashima, for sharing your views with us, and thank you also for listening so patiently.
Well, that's all on this episode of Voyage Navigate 2018, but there is a lot more to learn and a lot more to grasp about the Indian and global markets. We'll be back next week right here at Aditya Birla Sun Life Mutual Fund presents Voyage Navigate 2018, powered by ET Now. Thank you for watching.
Partnered by Times Influence.